Welcome to the Alternative Investment Podcast. I'm your host, Andy Hagans, and today we're talking about hedge funds and hedge fund ETFs. So this episode, I believe it's wrapping up our mini series that we've done on alternative ETFs and liquid alts. So a lot of insights that we've covered on liquid alts in these past few weeks, and very excited that joining me today is Bob Elliott, who is CEO at Unlimited. Bob, welcome to the show.
Thanks so much for having me, Andy. Really appreciate it.
And I love talking about hedge funds and hedge funds ETFs. I mean, with hedge funds, I feel like even just the word hedge fund, if you're not in that industry, it's like has this connotation of like a secret club or whatever.
Mm.
So Bob, I'm going to ask you to bring us, give us access into this secret club. But I want to start with your background because I know you've worked with some very interesting people in our space. You've done some very impressive things in your career. So how did you get your start?
Well, I actually started off at Bridgewater Associates right out of college, which is many years ago when Bridgewater was a bit of a challenger asset manager at the time. The thought was at the time that systematic or that macro investing really was for the savants of the world, the Soroses, the people who could sort of infer how exactly the macroeconomy was going to work. And, Bridgewater's real innovation in that space was bringing the sort of rigorous and systematic approaches that had existed for a long time in things like equity long short and areas like that, and bringing that understanding into the macro space. And so when I showed up at Bridgewater, there were, it was a few billion under management and a pretty small team. And over the course of almost 15 years, developed a deep, rich understanding of the macroeconomy, how it works, and then also built, a wide variety of systematic investment strategies, many of which were used in the flagship Pure Alpha Fund, across all the different asset classes. So it was really a great place to start a career because I got a great sense of all the different major asset classes, the strategies, as well as sort of foundational understanding of how to use systematic strategies to basically give edge in investing.
So Bob, how do you get that job right out of college? I'm like, were you valedictorian or?
Oh, far from it. Far from it. I had done a wide variety of different things. My background, academic background, is actually in the pure sciences, in botany, and I recognized I'd done a lot of botany research in my career. Realized I wasn't going to be a research scientist for my career, and recognized how important. I always had an interest in investing and the macroeconomy, and really recognized how important it is to driving darn near everything that's going on in the world. And so I showed up actually with the expectation of, going for a few years, kind of getting like a paid master's degree type idea. And almost 15 years later, I was still there. So, that's how I started. As I said, it was a very, at the time was a bit of a, it was a challenger organization. And so, was part of the small handful of investors that took it from being that challenger to being, now considered the incumbent.
Right. Yeah, no, that's amazing. And so you were there in the early days. You mentioned learning how the macro economy works. So I think the Federal Reserve and a lot of economists are also wondering, how does the macro economy work?
Well, I think well, first of all, the macroeconomy works very differently than what you learn in a college, macroeconomics class, or what a traditional academic finance education would give you. A big part of developing that understanding was sort of understanding and thinking about the intuitive cause-effect drivers of the macroeconomy and asset classes. And then from there, taking that intuition about those linkages, right? If If inflation comes in above expectations, you would then expect bond yields to rise. That's a simple linkage, which
Mm-hmm.
you can then quantify. What are the pressures on, inflation to rise relative to the pressures, well, relative to what's priced into the bond market, and you can start to quantify those linkages. And then, really, all systemization is the quantification and the and using that understanding in a repeated way over and over and over again, right? In a way that is disciplined, which is a very, the biggest benefit of systemization is quantification and discipline. So often investors can challenge, if you're a discretionary investor, it can be very challenging to basically keep true to your investment strategy, because you're always being influenced by the incremental information that's out there, and you may overreact or underreact, for instance, to that incremental information. And the beauty of systemization is bringing that discipline, helping synthesize a wide variety of information, bring the discipline to execute the strategy as designed. And so that really is the core of it. If you can do that, I think the important thing to recognize is, in macro, at least, like, your odds, even the best macro investors in the world are wrong about 55% wrong about 45% of their bets in any one month.
Wow.
But if you do that, if you have the coin on your side, 55-45, and you flip it, you trade 100 markets, that gives you a little bit of edge. And if you could trade that over time, at a 55-45 ratio, you're actually end up being, one of the best investors in the world. And so
you're the best blackjack player that's ever walked into the casino. Well,
that's right.
When you mentioned, inflation printing higher, and then, bond yields going up, or, these kind of linkages, spotting patterns, so to speak, kind of reminds me of like Jurassic Park, the chaos theory, butterfly flaps its wings in peaking, or what, because you can see those effects, right? I can say that. And did I mix that up, by the way? Did I get the bond yield thing right? I always mix that. But
no, you got it right.
Okay, good. You can see those effects, but here's what I'm thinking is, and I'm not a trader, I'm a long-term investor, but as a trader or whatever, there will be that linkage, but then there might be a Federal Reserve might do X, Y, or Z in response, or there might be a response from a policy standpoint, or the market might price this in. And I'm thinking, so then there's every reaction to the initial action. I'm like, there has to be like an order of magnitude less certainty in the reaction to the reaction. You know what I mean?
I think what the goal of bringing a systematic understanding to the world is not to have a perfect description of everything that happens, because there's a lot you don't necessarily know and a lot you can't predict. The idea of bringing a systematic approach to the world is to say, let me get edge in predicting what the various people involved in the markets will do. And so,
and is that short term though? I guess my point was, is that kind of like game theory, 90 days ahead or 6 months ahead? It seems like that'd be really challenging to do it like 5 years ahead, for instance.
Right. I think I agree that something like 5 years ahead is probably not really the best way to think about it. But I think the idea of saying that, various folks' actions are driven by a set of not necessarily cost-effective rules. They're not rules, but there are motivations. Mm-hmm. There is, whether they have access to resources or don't have access to resources, their motivations. Those are all things that you can think about. I mean, just recently, I was talking about how the Fed, people often will look at what the Fed says, particularly around what they say they will do in the future, and don't recognize that the motivations of the Fed, how the Fed reacts, is simply a function of how the data that they're seeing happens. What's coming in terms of that incoming data, and then they have an almost relatively constrained, set of decision rules that they use based upon that information, and then they make their decision, right? And so often, I think this is where you get edge. Often people will focus on either their own view of what the central bank should do, or what the central bankers are saying, or what they're predicting will happen, rather than just saying, hey, look, if I take the basic inputs of growth and inflation. I understand, the central bank has a set of levers, whether it's QE or interest rates, and I
Yeah.
can basically solve for and predict how exactly they're going to behave.
So wait, you're
Given
telling
that
me
set of
that
inputs and that set of response function.
you're telling me that then the chairperson of the Federal Reserve could essentially be a robot or an algorithm in the sense that their proposed action in a set of circumstances is very constrained. So it's almost like a rule set. And our experience from the past 36 months, I would say, the rule set may need adjusted, or we may need better data or faster ways to react to the data or something. But we're not here to talk about the Federal Reserve or just only the Federal Reserve.
I can talk about the Federal Reserve all day.
Well, I want to ask you because, in alternative investments, and this is my world, right? The show, the Alternative Investment Podcast, there are so many products, asset classes, strategies kind of underneath that umbrella. But broadly speaking, you have the whole liquid versus illiquid alts. That's kind of one way to categorize all alts. And then another way to categorize them, really top level, you have alternative assets and you have alternative strategies. So what you're talking about, I think, is alternative strategies. When we're talking about hedge funds, we're talking about hedge fund ETFs, mostly falling in that alternative strategies bucket. And when I look at your career and just even hear you talk, I can tell you have a passion for this stuff, for the alternative strategies. I guess what is it about alternative strategies that you find so compelling or so interesting or such an intellectual riddle?
Yeah, I find that at its core, what folks who are often pursuing these alternative strategies, and I'd say in particular in macro, is this understanding of how the whole system works. And it's not, it's not surprising. I come from a pure sciences background, which is really focused on how do you understand the totality of, a biological system. You could think about markets and economies as just a different type of system, and one that I think, frankly, is pretty neat because we operate inside it. So we're both actors within it and can understand our own behaviors, as well as abilities to step back and see how the whole system works. And so that's really, that's what I think is really interesting about understanding the macroeconomy and developing investment strategies. And a lot of ways, what investment strategies are ways in which you can express your understanding relative to how the rest of the market understands the world, because that's essentially what's priced in. Mm-hmm. And if you get it right, you've demonstrated that you have incrementally more understanding. And if you get it wrong, you demonstrate that you have an imperfect understanding of what's likely to transpire. And that sows the seeds of new learning, right? The best thing about investing in a macro sense is there's an incredible amount to learn. So, given that you're, at best right 55-45 at any month, that means that you're wrong 45% of the time, which means you have the opportunity to learn something new 45% of the time, which means that, frankly, this is something that is it continues to be enriching, continues to be challenging, right? Every day, there's a ton more to learn about the macroeconomy. And so in many ways, from like a career perspective, it's very enriching because you could basically constantly be learning. There's a reason why, many of the most famous macro folks that are around, they're still investing into their 70s and 80s because there's still more to learn, to understand. And I certainly have seen that in a 20-year career, and almost certainly will see that through the rest of my career.
And that's what I mean. Like it's clear that it's almost like an addictive riddle. It's like it's not just about maximizing profits. It's at some point it's intellectually stimulating. And as you say, even the very best hedge fund managers, in this space are correct 55% of the time. So I want to talk a little bit. I know we're going to talk about ETFs, but I also want to talk about hedge funds. So when we're talking about a macro hedge fund, I sort of understand the concept that we're understanding how the world works. We're finding these patterns, these linkages. we are maybe trading or investing in maybe 100 different markets or asset classes on various bets. Could we say bets?
You could
And you're
definitely
kind
say bets. Bets is
okay, sure,
okay.
sure.
And many times it's important. Bets is actually a great way to describe it. And the reason why it's a great way to describe it is because you always want to be thinking about, you have a bet, you have an expected, payoff if you win. If you're right, you have expected payoff if you lose. And
Yeah.
it also emphasizes the fact that there is uncertainty, right? And so you really do have to think about any trade that you do as a bet in one direction
So
or the other.
like even if you're pretty certain, there's a chance the Cleveland Browns might make the playoffs next year. Like there's a
Right.
probability
And
that could happen.
and when you trade markets, what you do
Yeah.
is it's not just about knowing the probability that the Browns will make it,
Yep.
which is probably zero. It's also relative to what's priced in. So it's not just whether you understand it, it's whether you understand it relative to the collective wisdom of everyone in the world who is also thinking about that question and essentially pricing, right?
And
so that's
that you might know that Browns fans are betting with their heart, not with their head. And so you're saying this is a market mispricing of this
that's right.
probability. So then I kind of get that. And so you're looking for alpha by saying such and such is mispriced, or the market or the aggregate, not really calculating the odds here, or pricing them in, or there's a way to play this trade. So then what does that look like in practicality? Is that buying derivatives, futures, options? Like how does that trade actually get executed, like in financial terms?
Yeah, I mean, there's a lot of different security styles that investors can use in order to express that view. People will regularly trade things like futures or swaps. Options are often popular for certain traders in terms of how they construct their views of the world, or buying and selling or shorting cash securities. So pretty much that's the beautiful thing when you think about a hedge fund. One of the great things that they have at their disposal is the ability to work across a wide range of different assets, and also to work across long and short positions, and to express that in a variety of different forms or structures.
So one more question about hedge funds, and then I want to move on to some other topics. But with traditional hedge funds, so our audience at the Alternative Investment Podcast, it's a combination of RIAs, high net worth investors, family offices, kind of spanning that whole universe. And certain types of alternative investment funds really open to any kind of accredited investor. And then at the other end of the spectrum, it's basically just institutional investors or very, very large family offices. What about a typical hedge fund? Or are they all over the map? Are they open for accredited investors, or do they tend to be more family office and institutional only?
Yeah, if you go back, actually, when I was starting my career, a lot of the primary interest in hedge funds was really from the big name institutional investors that everyone knows, the CalPERS and the Future Fund of Australia, the big sovereign wealth funds, all of those places. That's basically who the investors were in hedge funds. But over the course of the last 20 years, there's been an increasing interest and ability for smaller scale investors to get into many of these funds, whether it's structured as feeder funds, or various platforms like the iCapital platform or the equivalent platforms. Those different platforms have made the hedge fund the hedge fund structure and the hedge fund industry more accessible. The caveat to that is that it hasn't necessarily made the most sophisticated or the most successful funds more available to investors. And so what we have actually, I think, is a real bifurcation in the industry where the most successful, most sophisticated funds basically only take money from institutions because they can only take money from institutions, because in general, you'd only want to manage money, for 300 people rather than 3,000 people or more. Right. And so you have a challenge for many individual investors or smaller scale investors when it comes to getting a negative selection bias situation or not being able to access the best funds, which may even be closed not only to smaller scale investors, but even they may be closed to institutions because they've reached their maximum capacity limits. And so I think that's kind of what we're seeing in the industry is some risk that the newer entrance or the newer availability is also availability that's a bit worse than what you typically see, at the industry level as a whole.
So that's really interesting. And I want to put a pin in that point because we're going to kind of come back to that whole issue of access. And I'm bringing up some notes here because I want to get to your fund, but first I also want to talk about how hedge funds performed in 2022. This topic, we've covered that a lot on the show. Recently, we've kind of said that 2022 is like the year of alts in the sense where, and we had the Alts Expo show in December where we had a panel and it was like, number one, the inflows across the alternative investment landscape, very, very strong in 2022 overall, but also from a performance standpoint. I'm not saying every sector did perfectly or every sector, I'm not saying that, but overall, a lot of sectors in the alternative investment landscape, they did live up to the hype. There were less drawdown than you saw in fixed income in equities. For instance, managed futures, those were up 20% last year, right? After a decade of not doing too much. And we recently did a webinar on that. So I'll link to that in the show notes. But on to hedge funds. So this specific sector, you wrote a blog post about how they performed in 2022. Could you give us the headlines? Did hedge funds, did they live up to the hype? Did they do what they were supposed to do last year?
Well, I think if you take the overall hedge fund industry, which to be clear, is a compilation of a number of different strategies. So you've got your managed futures, your equity long short, your global macro, all those sorts of different fund styles. Mm-hmm. And you put all those together, what you see is that the hedge fund industry in aggregate did pretty well in a challenging market environment, right? At its 60-40, depending on exactly how you price it, was maybe down between 15 and 20%. Hedge fund performance, before you consider the fees that they may charge, individual funds may charge.
Who cares about fees? Come on, we don't even need to consider fees, do we?
Well, I think it's important to recognize to start without the fees, because that really tells you how good the strategies are. That's a very important thing. Let's start with the strategies. Hedge funds in aggregate were basically flat. Down maybe 1 or 2, a couple of percent.
Well, that's incredible in a year
over the course of 2022. Yeah, it was. Yeah. They did very well. And even if you dig into the sub strategies, a strategy like equity long short, which did not do underperformed in the sense of like relative to cash, it underperformed. It only fell about 8% relative to pick your equity benchmark, down 15 to 20%. And so even equity long short, which has been panned in the media for some reason, delivered 1,000 basis points of alpha relative to passive investing in the market. And so when you look at these strategies, what you see here is, they delivered a pretty good outcome in an extraordinarily challenging environment. And it highlights the fact that, hedge funds in these sorts of difficult market environments, they're very good at preserving capital in general, right? Mm-hmm. What they do is they cut their risk, they manage, they hold lower beta exposures, they find, value stocks and other value opportunities and move into those positions in order to be defensively positioned through these difficult market environments. I wrote that piece, the title of which is, hedge funds are playing defense effectively, which is exactly what they were able to do during the period. And I think it's important to think about the strategies and the goodness of the strategies, because that way you can separate. There's a difference between the goodness of the strategies and the costs, which are expressed in the fees, right? So I always like to start with the gross of fees returns to start to think about how good are these managers at actually, navigating the markets themselves.
Sure. Okay. So broadly speaking, you've already made the point, there's kind of a bifurcation in the hedge fund industry. Broadly speaking, it is strategy by strategy, but hedge funds overall performed pretty well. I mean, that frankly, that's a big part of the point, isn't just alpha, but it's also strong performance in a year where that traditional 60-40 portfolio has a drawdown. That's when you're thankful that you've invested in alternatives. But you've kind of alluded to, if I'm reading between the lines, maybe some limitations or problems for some investors trying to invest in these strategies, either access to the top quality managers, top quality funds, or the fees. I mean, and the fees in any investment product, I don't care what the product is. It could be S&P fund all the way to the world's most expensive hedge fund, which you might be happy to pay the high fees because it generates so much alpha. You always have to look at fees, right? Because as an investor, that's your triple net returns, fees, inflation, taxes, those are part of your total return. So, I guess to kind of set the table, I want to talk now about your ETF and maybe how it's a little bit different. So I'm talking about HFND. By the way, that's an awesome ticker.
Yeah, we were surprised that it was still available, but we were able to grab it, which is great.
Yeah, and I'm just pulling up my notes here, so I have the summary. This is the unlimited HFND multi-strategy return tracker ETF. And if I'm going to read from my notes verbatim, quote, the fund seeks to create a portfolio with return characteristics similar to the hedge fund industry's gross of fees returns, and believes the fund may outperform the hedge fund industry net of fees returns by charging comparatively lower expenses. Excuse me, Bob. Those are fighting words. So tell me about this ETF and the strategy.
Well, I think it's important if you take a step back and you think about the hedge fund industry as a whole. There are a number of problems, a number of pain points that investors who are outside of that sort of institutional area, that a number of pain points that they face. The first pain point is that hedge fund fees are very high. So if you take the hedge fund industry as a whole, they're typically adding between 300 and 400 basis points of fees on an annual basis. And what that does is it takes the returns of the strategies, which in general are actually quite good, like 100 basis points better than the S&P 500 over time, about half the volatility, about a third of the drawdowns. Like that's how good the strategies are and the managers are. But you add 300 to 400 basis points of fees, and investors look at something and they say, well, I'm not that much better off than I would be, doing it on my own. So you've got a fee problem. The other problem you have is a tax problem, right? The problem with an LP structure, typical LP structures, is that typically, they're taxed at, you get annual distributions, they're taxed at marginal income or worse. And so that's a real problem because
and Bob, that's with alternatives. That's something, I'm always looking at a product and I'm like, is this designed primarily for an institutional investor?
Right.
Because if so, I'm almost just going to move on instantly because
the taxes is such a huge problem.
Right.
And then the next problem you have is the diversification problem, which is that if you're a small scale investor, you can't buy into a wide variety or a diverse variety of funds because you just are not big enough to be able to invest in 50, 100, sort of the range of the number of funds that you'd need to have in order to really get diversification. Or if you do through a fund of funds, you end up paying fees on top of fees, and it's even worse, right? And then the last thing is, to be blunt, is the paperwork, right? Which is, if anyone, I'm sure plenty of people who listen to this podcast have signed up for various alternative investments where there's paperwork upon paperwork.
You're getting lots of K1s, Bob. You're getting a stack of K1s.
So much paperwork. And if you're a financial advisor, I frankly empathize with the fact that you've got to go track down all of your clients to get them to sign the paperwork, people who are busy, challenging to get in touch with, things like that. And so we saw all those pain points that existed in the market. And what we thought was there a way to bring the kind of low-cost, diversified indexing approach, which has obviously totally changed stock and bond investing, right?
Mhm.
Was there a
Yep.
way to sort of take that concept and apply it to the world of 2 and 20? And the first step of that is to think about it in the context of hedge funds. And so instead of pursuing that sort of strategy by investing in all these different funds, which you can't really do because the good ones won't take your money, and you pay fees and then you have to pay yourself and things like that.
Mhm.
What we thought was, could we create an ETF that leverages our experience having developed proprietary hedge fund strategies with modern machine learning techniques that have advanced a lot over the course of the last 10 or 20 years, to develop a technology that allows us to look over the shoulder of the hedge fund managers, see what they're doing in close to real time, take that understanding, translate it into long and short positions in various index products, and package that up in an ETF form. And that's really what HFND is all about, which is this idea of creating a portfolio which replicates the risk return characteristics, or replicates the returns, the gross of fees returns of the hedge fund industry, in that ETF wrapper, in order to address a lot of those pain points. And because we're using technology rather than, frankly, star PMs that you have to pay millions and millions of dollars, we can offer it at about a quarter of the management fee that a typical hedge fund would charge. And because it's in the ETF wrapper, it ends up being about twice as tax efficient, or half the taxes roughly, than it
Sure.
would be in a traditional LP structure.
Okay, so it's almost like a hedge fund for the little guy. I mean, I know it's not a hedge fund; it's an exchange traded fund, but it's replicating hedge fund strategies in it with machine learning. It so it's almost, there's a couple things going on here. If I'm unpacking it, it offers liquidity. There's not going to be a minimum investment, right? You can buy
Right.
one share.
You could buy. There's lots of investors that have come in that have bought one single share. That's
Wow,
for
that's
20
amazing.
bucks.
That's amazing. Yeah, so there's that side of it, but then there's also, because I'm thinking with the strategy that you're talking about with machine learning, and it sounds to me like machine learning could potentially really revolutionize the whole hedge fund industry. But even independent of the wrapper here, sounds like you've kind of lowered the cost structure of implementing the long short strategy. Are you the only guys doing that, where you've kind of figured out how to be the Costco? Are you the Costco of long short?
Right. That's kind of the idea is, if we can create what investors care about in the end is their post fee, their net of fee post tax return, right?
Mm-hmm.
That's what they really care about. And so by using technology, our replication of these strategies is imperfect because it's naturally, because it's not, we can't perfectly replicate investing in 5,000 hedge funds.
Sure.
But if we can do a pretty good job of that, to replicate the strategies, which, is based upon the fact that we have actually, between my partner Bruce and I, we've actually created proprietary strategies and all these different fund styles over the course of, I think, 50 years of combined hedge fund experience between the two of us. So we know how these strategies are created. We can therefore replicate how the strategies work, and what are the types of exposures and risk positions that these investors are taking on at any point in time. If we can do a pretty good job of replicating that, and then offer it at a lower management fee and a more tax efficient structure, the end result that the investor sees, and to be clear, in a more diversified package, which is a very very important component of it as well, the end investor sees a much more we expect that the end investor will see a much more consistent return stream,
Mm-hmm.
that and a higher return net of fees and taxes than they would were they to go out and invest in a handful of individual hedge fund positions,
Mm-hmm.
or frankly, a lot better than what they get if they invested in a fund of fund structure, which layers fees on top of fees.
Okay, so I think I get it now. A couple last questions on the fund. So you're using machine learning to kind of make it more cost efficient, just efficient overall to make these trades. That's overseen by you and your partner? You kind of like the human gut check, I guess, layer of supervision of the machine.
Of course. I mean, it's neat that we started this conversation talking about the development of systematic investment strategies, which, both of us have done for decades. When
Mhm.
you are a manager of systematic investment strategies, you know, you still have to manage the money, right? That
Right.
is a critical component, and that doesn't mean that what we're doing is applying our own discretionary views on markets. We're not doing that. We're using a systematic process to essentially understand the wisdom of the crowd of hedge fund managers,
Sure.
right? Take that understanding and translate it into those long and short positions that back the ETF. But that process means consistently monitoring and evolving the underlying systematic process to the extent that we see things that can improve the way in which we replicate those strategies.
So yeah, that makes sense. And so this is an actively managed ETF, and it's interesting, reflecting again, we've done this kind of mini series on liquid alts and alternative ETFs. And my partners and I, we co-founded ETFDB, ETF database back in, I think it was 2009. We were kind of covering, it wasn't the very beginning, but the earlier days of the ETF beat. And actively managed ETFs were kind of like, they were pretty new, and they weren't very well received. Like wave one of them was just everybody
Right.
kind of was rolling their eyes, so to speak. And I might call this like the third wave or even the fourth wave of alternative ETFs and liquid alts. Kind of depends how you count those waves. But you know, do you think that liquid alts and alternative ETFs, hedge fund ETFs, all these alternative strategies, is there finally, do you feel like the market, RIAs, investors are finally really accepting them? I mean, obviously the AUM kind of speaks for itself, but is there more openness? Do you think that's a trend with liquid alts? It's just more openness to active management?
Yeah, I mean, we're really seeing, with our product, we've raised $70 million and it launched just a touch over 3 months ago. So I
Yeah.
think that speaks to the demand and interest both for alternatives in general,
Mm-hmm.
as well as the particular structure and approach that we're taking to it. And I think a big part of that is, ETFs in the past were seen very much as the way to run very low cost, liquid indexing products.
Mm-hmm.
And increasingly, investors are recognizing that you can run more sophisticated strategies in the ETF wrapper. There's also been actually some regulatory evolutions, which haven't gotten a lot of press outside of, the real ETF nerd community,
Right. Yep.
that allow managers to run more sophisticated strategies, and in exchange for basically implementing what I describe as institutional quality, common sense risk controls. So that's a good thing. It's a good thing for the industry because it
Yep.
allows more flexibility and increases the risk controls that are in place for the end investor. And so that actually is, a number of those regulations passed back in 2020, 2021, and I won't nerd out on them there for you. But what I will say is it actually it's opened the door for the next generation of sophisticated products. Because overall, if you think about the ETF structure is the best structure for the investor. There's no question about that. It's liquid, it's transparent, it's,
It's
it's
tax efficient. Yep.
tax efficient,
Yep.
right? And it's executable without having to fill out any paperwork, right? Like all of those things make it much, much better. And because it's also tradable and because it has, there are liquid underlyings, you can trade into it, you can trade out of it. If you like the product, you can stay in it. If you don't like the product, you can just, there's no redemption process, no big redemption process with paperwork. You just
Right.
sell it and you're out, that day, right? That's the whole benefit of the ETF structure. And I think, managers like us are increasingly recognizing that investors and advisors in particular are demanding that they get investor-friendly structures for the products that they're going to buy, right? They understand that low-cost, tax-efficient liquid products are the best thing for their investors, and so they're demanding that. And so we've just thrown out the first pitch, so to speak, on the evolution of sophisticated investment strategies, moving from mutual fund products and LP products, and those moving into the ETF structure. And I think that's very exciting. I think there's a lot of great promise available, and it will no doubt significantly benefit the investor as this transition occurs. And ultimately, that's what we should be doing, is trying our best to figure out a way to benefit the investor, not to enrich the manager through these strategies.
Well, that's why the whole industry exists, as far as we're concerned. Yeah, and we're almost out of time, but you kind of teed me up for one more question, Bob. You referenced the first pitch being thrown, and I love my baseball analogies, but I do feel like this is a little bit of a battle between hedge fund ETFs and hedge funds, in the sense that for some investors, they may view them as a substitute. Some investors may want both. And, because I mean, personally, I can see, especially for a high net worth investor, for a family office, you might want some liquid alts, and you might also want some traditional illiquid alts in a portfolio. I can see an argument for even including both. But do you see hedge fund ETFs as a whole, not just yours, but as a group, and alternative strategies ETFs, are they going to gain ground at the expense of traditional hedge funds? Or is it just, within alts, are they all going to grow? Are they all going to continue growing?
Yeah, I think we're likely to see over the course of the next 5 or 10 years a rationalization of fees, I think, in general across the investment management industry. Like, when all assets are going up and money is easy, no one really cares if your fee is 100 basis points, 200 basis points, or 400 basis points. It kind of gets lost in the shuffle. Yeah. We've entered, a macroeconomic environment that's very much the end of the era of cheap money. And that means probabilistically lower returns, particularly for beta, for passive investing. And that means, that the skill of the investor, the actual skill of the investor relative to the fees that they charge, is really going to come into focus over the course of the next, 5 or 10 years. And that's where we're probably, in the hedge fund industry, going to see a real bifurcation. There are absolutely hedge funds that deserve the fees that they charge. They generate unique and differentiated alpha. They may even charge high fees, but when you net that out for investors, it makes sense. But that is also a relatively small portion of the hedge fund industry. And it's a part of the hedge fund industry that's very hard to access for the vast majority of investors, basically only accessible for the biggest, most sophisticated institutional investors in the world. For the rest of the world, who aren't those big, sophisticated institutions, we're going to have a real reckoning of the rest of the hedge fund industry, where, frankly, the vast majority of the hedge fund industry does not justify its fees, right? And so when we see these various products, these various innovative products that are replicating hedge fund style strategies, but doing it at a quarter of the cost and essentially half the taxes, there's going to be a lot of people who are going to look at, investing in the sort of average equity long short manager, the average macro manager, where their fees don't make sense in the context of the alternative options that are available. And so increasingly, we're going to see a bifurcation between, money's going to go as much as can to the best, most sophisticated managers. And then I suspect we're going to see a lot of capital flow into these increasingly sophisticated replication strategies put in structures like ETFs. And that, will vastly benefit, that'll benefit investors incredibly, because they'll get access to sophisticated investment strategies that are diversified and more consistent and much lower cost, relative to where they were, over the past 10 or 20 years.
Yeah, absolutely. I mean, and, I cover alternatives, whether liquid alts, or I call them traditional alts, which is maybe an oxymoron, but, illiquid alts. I invest in both. I cover both. To me, it's not an either or. I just love the existence of new products when, I think that the point you're kind of alluding to is just that give investors more choice. and put pressure on everyone, every
Right.
every asset manager to just be on their game and to offer the most value as possible within their sector and within their segment. That's a very good thing. So, Bob, can't thank you enough for coming on the show today, sharing your insights not only on hedge funds, but replication strategies and your ETF. So, where can our audience of high net worth investors and financial advisors go to learn more about Unlimited and about your fund?
Yeah, for sure. The best place to go is our website, unlimitedfunds.com, where you can check out more information about the HFND ETF, as well as some regular commentary that we're writing on various investment topics in our blog. The other place you can check me out, sort of the start of this conversation, is I'm still keeping up with macro in a fair amount. Part of our view of the world is not to just make the return streams more accessible, but also make the understanding of the macroeconomy more successful. And so if you're interested, check out my pretty active Twitter at Bob E Unlimited on Twitter. I'm there all the time talking about what's going on in the world and the macroeconomy.
Yeah, and Bob, I follow you on Twitter, and I'll be sure to include a link to your Twitter in our show notes, which, as a reminder to our listeners, you can always get our show notes at altsdb.com/podcast. Bob, thanks again for coming on the show today.
Thanks so much for having me. It was really fun.